In March of this year, the Reserve Bank of Australia raised interest rates for the second time in 2 months. The cash rate went from 3.6% to 4.1%. On a $600,000 mortgage, that adds around $180 a month in repayments, every month forever until rates come back down. Nobody voted for it. Nobody in Parliament debated it. 9 people in a room in Sydney decided, and as a result, 3.3 million Australian households are paying the price. Here's what I want to argue in the next 10 minutes, and I don't think this is a controversial take once you see the numbers. Every time a central bank moves interest rates, they are redistributing wealth, not accidentally, by design, and almost always in the same direction. 3 things I want to answer in this video. Who actually pays when rates go up? Who actually gains when rates go down? And why the system over the last 40 years has moved money from one specific group of people to another, consistently, measurably, every cycle. I'll tell you the punchline early, the group losing is probably the one you're in. Let me start with what an interest rate actually is, because once you strip away the technical central bank language, it's simple. An interest rate is the price of money. How much it costs to borrow, how much you earn for lending. When a central bank cuts rates, they're making the money cheaper. When they hike, they're making the money more expensive. For example, if you own a mortgage, a rate hike takes money out of your pocket every month. But if you own your house outright, a rate hike doesn't touch you. If you own 10 houses as investment properties, a rate hike might hurt you, but you probably could have locked in fixed rates and your rental income goes up anyway because other landlords will pass on the costs. Now you just flip that. When rates get cut, which is the more interesting half of this story, money becomes cheap. Borrowing becomes easy, and the first people to access that cheap money are usually not you and I. It's banks, corporations, private equity firms, institutional investors, people already holding assets. Those groups use the cheap money to do one thing: buy more assets, stock, property, companies. The more they buy, the higher the price goes, and the higher the price goes, the more they make, because they already owned the stuff before the prices went up. This has a name in economics. It's called the Catalonian effect, after an 18th century economist who noticed something weird. When new money enters an economy, it doesn't arrive everywhere at once. It arrives at very specific points. Whoever's closest to the central bank gets it first. Those people get to spend it at old prices before the rest of the economy adjusts. By the time the cheap money reaches the wage earner, through higher prices at the shops, higher rents, higher house prices, it's already made the people at the front of the queue considerably richer. Richard Catalone wrote that in 1730. The mechanism has not changed here in 2026. From 2008 to 2022, most of the developed world ran the largest experiment in cheap money in human history. The US cash rate was held near zero for almost all of that period. The ECB went negative. Japan's been there for 30 years. Australia got to 0.10% during COVID. In the same window, US M2 money supply went from 7.5 trillion to over 22 trillion, nearly tripled. Where did that money go? It wasn't to wages. In Australia, real wages over that period barely moved. In the US, median real wages grew less than 10%. The answer is it went to assets. The S&P 500 went from 700 points in 2009 to over 6,000 today. Sydney medium house prices went from 540,000 in 2008 to over 1.6 million. That's roughly a tripling of stock wealth and a tripling of the house you couldn't afford 15 years ago. If you own those assets in 2008, the following 15 years were the greatest period of wealth creation in modern history. If you were trying to buy your first house, they were some of the worst times in history. Two people in the same city, same year, same economy, same interest rate policy, but it's opposite experiences of it depending on what side of the fence you fall. They weren't in the same economy at all. They're in two halves of one that is split. In the US, the top 0.1% of households now own more wealth than the bottom 90% combined. That wasn't always true. It became true during the cheap money era. The official story we get told on interest rates usually sounds something like this. Interest rates are the natural tool for managing inflation. When the economy overheats, we raise them. When it slows, we cut them. Yes, there are distributional effects, but they're secondary. The main thing is macroeconomic stability. While every word of that might be technically true, and every word of it generally also dodges the actual question. Because here's what nobody wants to say out loud. The central bank's goal is price stability. The tool they use is interest rates, and the way interest rates work is by hurting specific people enough that the whole economy slows down. Think about what a rate hike is supposed to do. It's supposed to cool demand. What that means in plain English is make some households so financially stressed they stopped spending. That's the mechanism. It's not a side effect, it's how the tool does its job. And who gets stressed first? The people with the most debt relative to income, which is young families with mortgages, renters whose landlords are passing on costs, small business owners on variable rate commercial loans. These people not only get hurt first, they get hurt the most. Who doesn't get stressed? People with no debt and lots of assets. They own the houses being sold off. They hold the deposits that now pay 5% interest. Every rate hike transfers money from the first group to the second while the economy slows. It's not a flaw, it's the exact outcome the system is designed to produce. When the economy eventually slows too much and a recession threatens, the central bank cuts rates again. Cheap money comes back. Asset prices rip upwards. The people who bought those assets during the cheap downturn, because they had cash, because they had access to credit, because they weren't the ones who got foreclosed on, make a fortune. The cycle, it doesn't transfer wealth randomly. It transfers wealth in one direction every time. That direction is from people whose income comes from wages to people whose income comes from owning things. Let's bring this back to today, to Australia in April 2026. The RBA has just put rates back up to 4.1%, 2 hikes in 2 months. They're signalling more could come, and they're not forecasting cuts until inflation is properly back in the target band, which by their own projections is mid-2028. If you have a mortgage, you know what that means. If you're renting, you now know what that means. Your landlord's costs, they're going to go up. They'll pass it on because every landlord does. Here's what's worth understanding though. The RBA is not doing this to you or I out of cruelty. They're doing it because inflation is above target and interest rates are the only tool they've got. But, and this is the hard part, the tool by design solves inflation by making specific people poorer. That's not a conspiracy. If it was, you'd expect to find periods where interest rate cycles transferred wealth towards wage earners, where the bottom 50% gained ground on the top 1% during a rate cut cycle. You won't find one in any developed economy within the last 40 years. That's not ideology, that's just what the data says when you look. And when rates eventually get cut again, whether that's late 2027, 28 or 29, the people who gain from cheap money will be the same people who gained last time. If you own the assets, the cycle is a racket. You go up in the good times and you hold your ground in the bad times. If you don't own the assets, the cycle's a treadmill. You run harder and you lose ground anyway. And the quiet, uncomfortable thing nobody in finance will say on camera is this: the longer the cycle runs, the harder it gets for anyone on the treadmill to ever get off of it. Because the price of getting off, owning a house, owning shares, owning a business, keeps rising faster than wages. Every cycle pushes the door further and further away. The top 10% of households by wealth capture the overwhelming majority of asset price gains. Every QE cycle since 2008 has widened the gap. Now, it might not be called a wealth transfer. It's called monetary policy. But following the flow of the money, measured in dollars, goes in exactly one direction, consistently cycle after cycle. If an accountant described the same pattern happening anywhere else, they'd use the word transfer without hesitation. Here's what I want you to take away. Interest rates are one of the most powerful redistributive tools in the modern economy. Every time they move, money moves with them, almost always in the same direction. What you need to understand is where you sit with this move. If you hold assets, you're going to view it positively. If you're someone trying to buy a house, when interest rates go up, that's a nightmare. I want to continue to do more of these types of videos talking about how the economy is shaped and we move through it. I've got some videos discussing general commodities such as wheat, gold, and salt. This video series I'm calling Zoom Out, and it's the first one. I'd love to hear your feedback. I'll be doing them monthly with a couple of shorts thrown in as well. How do you feel about interest rates? Do they hurt or help you? Do you hold assets or are you trying to get into the asset class? Let me know in the comments down below. I'd love to hear from you. Thanks for watching.